Here, doing another video. We're going to be jumping into kind of where the market's at, second wave of the virus, its impacts on both businesses, but also kind of on markets as a whole. But first things first, Scott, how are you?
I'm doing great, Jason. How you doing?
I'm good. I'm good. Now, do you want to maybe chat, about what things are like in Texas itself? Maybe kind of is second wave of the virus hitting as hard? What's happening in terms of kind of government side of things there?
Yeah, it's really interesting. They opened everything up, and like I expected, as soon as they opened everything up, there's a second wave hitting, and we're having record virus every single day. So I don't know, Jason. I mean, I think it's going to be a while. We're going to have to work through this. It's a double-edged sword, right? If you don't open the economy back up, everything goes to hell in a handbasket, and we're all pretty much hosed. If you do open it up, there's going to be a certain percentage of people that are going to get this virus, and until we come up with a vaccine, it's just the world that we're going to have to live in right now.
Yeah. I mean, some people are saying, well, look, I mean, it's getting to the point where obviously, I mean, people are homesick, let's be honest, or whatever you would call it, cabin fever, I guess, where they
Mm.
want to do something. Um, and you're getting people that are saying, well, if you've got someone high risk or you're high risk, then, maybe you need to take more precaution and you don't need to go out. You can still order, still act like it's lockdown, but other people who are, lower risk can go out and do whatever they want to do. But do you want to chat about maybe what this second wave of the virus and the impacts that it might have on the financial markets as a whole, and what your kind of thoughts are and what your perspective is?
Yeah, I think it's going to create volatility. The first wave created volatility, and the market went down, and the second wave is probably going to create more volatility. We're going to have more days where the market's up 1,000 points and down 1,000 points the next day. It's just going to, be the new world that we live in until we have more calm around us. But I don't think that's necessarily a bad thing, Jason. It's interesting. You look at Nordstrom's twice a year, they have a huge sale, and people line up around the block to go in and buy things at a discount. We should be looking at this the same way. It's really crazy because when Nordstrom's has a sale, everybody lines up. But when the greatest companies in America, when they go on sale, everybody gets scared. It should be exactly the opposite. We should take advantage of an opportunity and buy the greatest companies in America when we can. And if we can do it at a discount, absolutely, you should jump right in.
You're touching on exactly where I was hoping to go, and some people are treating it like a discount. They're thinking about the Warren Buffett kind of mentality. They read books, they watch YouTube videos, you name it, where it's, hey, buy when you can get it cheaper and buy in times like this. You want to maybe chat about the new blood that's come into the kind of financial world, especially the investing world. You're seeing retail, Robinhood, like all these other things blowing up, and people investing in companies that maybe you think are a little bit aggressive, Hertz and some other ones that are going to be getting bailouts and things like that. Do you want to maybe give any insight and talk about the big impact that retail is having on the markets themselves?
Yeah, I mean, obviously, over the last couple of years, it's been this trend towards the quote unquote robo advisor, the computerized trading, the computerized asset allocation modeling for retail investors. And it's been successful. I mean, they've raised quite a bit of assets. My fear is that there's a couple driving factors in human beings: fear and greed. And until we learn how to repeal those emotional responses, we're going to react to market cycles. On the aggregate, human beings they're going to react in the same way. Which, when the markets go up, straight up, they get greedy, and when the markets go down, straight down, they get fearful. And it's just unfortunate, but people have the tendency to do the wrong thing at the wrong time when it comes to investing. And there's a lot of studies. There's a lot of studies that back this up. There's a lot of studies that show that, the average investor underperforms the stock market by 3 to 3.5% every single year, year in and year out. And they do it because of fear and greed. They buy at the wrong time and they sell at the wrong time. And they do this continuously. It's a continuous pattern throughout their entire investment lifetime. And if you take 3-4% and you extrapolate that over 20 years or 30 years, it's just a boatload of money. It's a difference between having $1 and potentially having $4 over a person's lifetime.
Yeah, no, for sure. It adds up, compounds, it adds up quickly, of course, like you're saying. You want to maybe talk, I mean, it's not just, people think, oh, it's just millennials hopping in. No, it's just people that are familiar that, hey, maybe now's the time to buy. Do you want to maybe give any insight, obviously dealing with the financial markets, advisors as well? You guys want to talk about anything, maybe quick insight or advice you might give to someone who's looking to get in? And maybe if we want to tie this in, this can be a later question we can cover, but maybe tie this into why financial planning might be important for these types of people. You already mentioned that a lot of them underperform the stock market, but you want to touch on anything else?
Yeah, Jason, I think that was a really good segue into why it's important to have a professional financial advisor or financial planner on your side. When you look at the robos that we just talked about, they provide a service, and that service is access to investments, access to an asset allocation that may be appropriate to that person based on their risk tolerance or how they feel about risk. But they don't provide the ability to reach out and hold your hand and tell you that it's going to be okay, and help you through those emotional states that drive these bad decisions. And that's why you have a professional financial planner. A professional financial planner will look out over the next 10, 20, 30, 40 years of a person's lifetime and create a plan. And then, you've heard the old saying, you create your plan and then you play your plan. And you need to have somebody there to hold your hand and make sure that you stay the course. And if you have that person, you're going to do better than if you don't. And there's been a lot of studies that have proven that. I mean, you look at a professional golfer. A professional golfer has a coach that helps them with a putting stroke. I mean, think about how ridiculous that is. I mean, a putting stroke, you move the club head back 3 or 4 inches, and then you move it forward just 3 or 4 inches. There's not much to it, right? But they have a coach, somebody there that analyzes that total movement of 5 or 6 or 7 inches and helps them stay on target so that they do it proficiently and do it effectively and help do it so that they're going to maximize their their time on the putting green, so they'll put as many putts in the hole as possible, right? Professional golfer has a coach that studies their swing and helps make sure that their swing is on track. But you could take that one step further. I mean, you could take it through that analogy through any sport. Most any professional athlete has a coach that helps them make sure that they're on track, that they don't absorb any bad habits into what they're doing, and make sure that they stay the course for the long term. And that's what a financial professional should do for a person. A computer just can't do that. Not yet. I don't know what new wave of AI is going to bring in the future. I don't know if we're going to be in some strange alternate reality movie like we've seen in the past. But right now, the financial professional is your best bet to make sure that you stay the course, make sure that you have a good plan, and make sure that you attain your goals.
Yeah, and I think kind of ties in where we were talking. It's easy to make money when the markets are going up, but financial uncertainty is what makes people interested in coming up with a plan and hopping in. And I hope that now with a lot of the increase in retail, you might also see a big increase in kind of financial planning, people having an interest in the markets that otherwise didn't. I'm sure we both know people that had a ton of money but weren't really trying to get into the markets or were scared or this or that. And I know a ton of people that are becoming a lot more comfortable. They're seeing, and it's sad, but they'll be on Twitter and they'll see some professional athlete that says, "Oh yeah, I've just bought Tesla stock," or this or that. I mean, a lot of these bigger influencers are becoming a lot more warmer to investments and to speaking their mind. And hopefully that's a great benefit to financial planning as you guys go forward.
Yeah, absolutely, Jason. When you're talking about Tesla stock or you're talking about any investment, that's just a vehicle, right? When you're talking about long-term financial planning, you're talking about, where a person is right now today, and then where they want to be 10, 20, 30, 40 years from now. It's a process. It's a plan. It's not easy. It's something that takes discipline. Whether they buy Tesla or buy any other stock, that's just a small teeny little vehicle to help them get to that place. But as I mentioned a few minutes ago, Jason, right now we have an incredible opportunity. The greatest companies in America, they're on sale. Nordstrom's is having their half yearly sale. Jump out, be part of that. Don't buy when everybody else thinks you got to buy because it's going straight up. Buy when everybody else is a little bit fearful, and you're going to do much better.
Yeah, the Warren Buffett approach to a degree. I mean, do you want to maybe chat? So, that kind of three-part question that I asked before. Do you want to maybe talk about, the advice that you might give to someone who's stepping into the markets for the first time? Obviously, having some financial planning is a huge benefit, but talking just about the financial markets, maybe potential industries to look at or things to look at, make sure you're not doing this, make sure you're doing that type of, kind of insight.
Mm-hmm. Mm-hmm. Yeah, I mean, that's interesting. I see a lot of people jumping into the market, and they're saying, okay, well, look, cannabis stocks, they've been hot. We got to jump in. We got to chase them. Just recently, it looks like they've had a little bit of a pullback, and they've come out of favor. And I don't know. I think that if you're jumping into one industry like cannabis, or you're jumping into something that is undiversified, it's gambling, right? If you invest for the long run and you find companies that are solid companies, that are real companies that are producing something, and then you diversify across several companies, you're going to be a successful investor. You've mentioned Warren Buffett a couple of times, and absolutely, you don't put all your eggs in one basket and you buy value. You buy companies that you think have a good long-term outlook. You don't buy companies because you think they're going to pop in the next 30, 60, 90 days. You buy companies that you want to own for the next 5 years, 10 years, or 20 years.